Thanks for joining us at this briefing. Hamish, the market knows us as an active stock picker with risk management at the core, but there are plenty of macro issues that obviously are going on in the world at the moment. What is your view on the European debt crisis?
Well, Frank, currently there is obviously a lot of uncertainty, a lot of market uncertainty in regards to Europe. From an investor's point of view, I think what you really need to focus on is there a material risk that we're going to get an uncontrolled default, a sovereign debt default within Europe? Because if we did have an uncontrolled sovereign debt default, it really could lead to a very, very adverse scenario where we could see multiple banks across Europe collapse. It really could be a rerun, or even a worse rerun than we saw late 2008 after Lehman Brothers collapse. The most likely area for an uncontrolled default is what's occurring in Greece at the moment. They're currently in a policy of really providing drip feed liquidity to Greece, and Greece on the other side has to enact very tough austerity plans, and you're seeing riots in the streets of Athens as these are pushed through, as they were recently. My fear is that in 6 months' time, even when we get this package through that's being debated at the moment, we're going to be in the same situation all over again, where the Greek economy has deteriorated, more money is needed from the European Union and the IMF, and they will want Greece to go further than they've already gone. So I don't think we're really solving the issue at all in Greece until the regulators can really come up with a solution that comprehensively addresses the default risk in Greece. I don't think we're going to see any end to the uncertainty in the short term in Europe. The good news is I actually think the risk of a uncontrolled default happening in a country like Greece at the moment is actually very low. I think all the regulators fully understand, and I think they're going to do just enough at whatever time to stop that happening. But what it creates, whilst you're just doing just enough but not a comprehensive solution, is you create all this contagion and uncertainty. And I think we've got at least 12 months more of it. But I don't see it as a situation where we're going to get an uncontrolled collapse in the financial system. So I'm relatively relaxed if you stay away from the most volatile areas, particularly financials within the European Union, is something I'd probably stay away from.
There's lots of comment around the increase on the debt ceiling in the US. How do you think this will pan out?
Well, all logic would tell you that the United States before August 2nd will pass legislation to increase the debt ceiling. It is completely illogical not to, but the problem is we're dealing with politicians, and we're dealing with politicians who have really dug themselves into a very, very deep ideological hole here. And there is a risk, and every day that goes past, the risk actually increases that they could stare down the August 2nd deadline, and we could actually see the debt ceiling not being extended by that date. In the long term, I don't think it's going to make any difference. I don't think there's any real chance in the long term that the United States won't be able to repay or finance its debt. A country, of course, doesn't have to repay its debt. It's a perpetual enterprise. But the US debt situation itself isn't something that really alarms us. But in the next 3 weeks, we could have a very volatile equity market if truly the politicians in the United States don't come up with a package to extend the debt ceiling.
And Hamish, what are the consequences of the debt ceiling not being raised?
Well, it's actually hard to predict. I think the first consequence, most likely, we could have a very sudden and sharp reaction in the stock markets. It may not last for very long because the regulators could rapidly react to such a reaction. Like when the first HARP program was voted down after the collapse of Lehman Brothers, we saw the equity market sell off 10%, but rapidly regain that as a program was put in place. I think most markets would expect that any default, if or a technical default, would be a short-lived circumstance. There isn't really a sovereign risk in the long term for the United States, but you could see an enormous amount of short-term volatility. It would depend on exactly what was being said and exactly the circumstances. Again, I think it's a low probability it's going to happen, but it's not zero at this point in time.
Longer term, Hamish, what are your thoughts on the US government reducing its debt levels?
Well, over the long term, if you look at the United States, the US is a very lightly taxed economy. So there's significant scope on taxation reform. Of course, the Republicans and particularly the Tea Party element are very opposed to any form of increased taxation. I don't think that is sustainable, and I don't think that the solution needs to be a cancellation of the Bush tax cuts either. There is an enormous amount of reform that can be done on taxation at the corporate level, and also an enormous amount of deductions around healthcare, around housing input costs, and maybe a few tax rates, but I see a lot of scope there. I also see a lot of scope on the entitlement and healthcare side of the debate, and of course people need to realise the US, because of the depth of its housing market collapse, its unemployment rate through the cycle won't remain where it is. When housing construction gets back to sort of 1.5 million units from about 500,000 units, and we think that will happen over the next 3 years, I think you'll see a large increase in employment in the United States, and the unemployment rate may come down to say 6. That will lead to a big change in the budget deficit position, irrespective of any other changes. And given the debate that's happening, I do see post the next presidential elections in November next year, I do see there will be some give and take on this debate, even if we don't see it pre-August 2nd this year, which may be somewhat unlikely.
Notwithstanding the macro issues, how comfortable are you with the position of the Global Fund at the moment?
Well, Frank, to be truthful with you, I'm very relaxed about the position of the Global Fund's portfolio. At its core, we continue to hold some very low risk stocks in the portfolio. Many of our large consumer staples, which makes up nearly half of our portfolio, are inherently very low risk businesses and dependent on long-term growth in emerging markets, and their low volatility. In terms of financials, other than our big sell down post the collapse of Lehman Brothers, we're probably one of our lowest exposures we've actually had to the banking sector. It's about 10% of our portfolio in 2 large US banks that are very, very well funded at the moment, but the exposures are modest that would be directly correlated with some of these issues occurring at the moment. And we're very overweight some very high growth areas such as payments and e-commerce and the internet at the moment, and those companies are actually performing incredibly strongly at the moment. So I think we have got very low weight in the higher risk areas of what's the centre of the storm at the moment, and deliberately so at the moment. The rest of the portfolio is pretty low volatility or supported by very, very strong fundamentals at the moment.
And the portfolio currently holds 3% cash.
It's an interesting observation, Frank, that we're at 3% cash, notwithstanding these issues I talked about earlier about the issues with there is a probability, I think it's low, that the debt ceiling won't get extended. That could lead to volatile equity markets over the next 3 weeks or so, and I'm sitting at 3% cash, and these issues going on in Europe, there is a risk of an uncontrolled default, which could be catastrophic in terms of financial systems around the world, but I'm sitting at 3% cash. And the reason is I view both of those, the event risk around those, as very low probability at the moment. Whilst I can see market volatility, we're really not trying to time stock markets. What we're trying to do is reduce what we call event risk, and we view that event risk, even though it's fairly visible at the moment, we view it as fairly low probability, as leading to an end game that could really destroy people's capital within our portfolio. But should we change our assessment of the probabilities, we would have no hesitation in dramatically increasing our cash weighting. But at the moment it's 3%, and we view the portfolio as pretty well structured in this environment.
Thanks, Hamish.
Pleasure, Frank.
And thank you for joining us at this briefing, and feel free to contact us should you require anything further.